Every year, around the middle of October, you sit down and tell the Australian Taxation Office exactly what you earn. And every year, on the strength of that one number alone, it decides which version of itself you get to deal with for the next 12 months. Most people assume the difference between the levels is just the percentage. It is not. The percentage is the smallest part of it, and it is the part that gets all the attention while the rest of the machinery stays completely out of view. There are 4 levels of income in this country, and at each one, the tax office charges you differently, watches you differently, and hands you a completely different set of rules. Same agency, same forms, same building, 4 completely different experiences of the same institution, and almost nobody ever sees more than one of them. So let us go through them properly, using the rates that came into effect on the 1st of July this year. Level 1. You earned $19,000 this year. Your name is Tara. You are 22, you work casual shifts at a garden center in Toowoomba, and you spent most of the year studying. You have never spoken to anyone at the tax office, and you would not know where to start. Tara pays almost nothing at all. The tax-free threshold is $18,200, and it has not moved a single dollar since 2012, which quietly means it has shrunk in real terms every year for over a decade. Above that, the second bracket now sits at 15%, cut down from 16 on the 1st of July this year, and legislated to fall again to 14 in 12 months' time. But she also gets the low income tax offset, worth up to $700, which is applied automatically when she lodges. She does not have to claim it, ask for it, or know it exists. In practice, it lifts her effective tax-free threshold to around $22,800, which is $4,500 higher than the number everybody quotes. And the Medicare levy does not touch her either. Most people think it is a flat 2% on everyone. It is not. Below $28,011, it is nil. Between there and $35,014, it phases in gradually at 10 cents in the dollar. So the full 2% only bites once you are properly clear of both numbers. So at level 1, the tax office is essentially absent from your life. You lodge, you get a refund, and nobody at that agency ever thinks about you again. The relationship is entirely one-directional, and it flows toward you. So that is level 1. The tax office is a form you fill in once a year and then forget about. It costs you almost nothing, and it asks you for almost nothing. Now watch what happens when the number goes up. Level 2. You earn $80,000. Your name is Marcus. 34. Works in council road maintenance in Ballarat. 2 kids, a mortgage he refinanced last year, and a 15-year-old ute that he keeps meaning to replace. On $80,000, Marcus pays $14,520 in income tax. Add the 2% Medicare levy, and it is $16,120. He takes home just under $64,000, which is the number that actually lands in his account across the year. His marginal rate is 30%, and that is the number that actually governs his decisions. Every extra dollar he earns above $45,000 loses 30 cents before it ever reaches him. Overtime on a Sunday, a second job, a small side business run out of the garage. All of it is priced at 30 cents, and 32 once you count the Medicare levy sitting on top. And this is the level where the system starts asking things of you. Work-related deductions need receipts. If he has an investment property, it goes on the return with every expense itemized. If he sold shares at any point in the year, that goes on too, with dates and cost bases. The form gets a little longer every year, that his life gets more complicated, and the number of things he could get wrong grows with it. Level 3. You earn $117,000. Your name is Priya. 41. A project manager in Sydney, and no private hospital cover, because she looked at the premiums 3 years ago, decided she was healthy and rarely went to the doctor, and worked out she would rather keep the money. On $100,000 of taxable income, the tax is $20,520 plus $2,000 in Medicare levy. But Priya has a problem that Marcus does not have, and it has nothing to do with how much she earns or what she does with it. It is the Medicare levy surcharge. Because she has no private hospital cover and her income for surcharge purposes is over the threshold, she pays an extra 1% on top. The Australian Taxation Office uses almost exactly this example on its own website. On $117,000 of income for surcharge purposes sitting in the first tier, that surcharge comes to $1,170, which means the private health insurance she decided not to buy would have cost her roughly the same as the penalty she now pays for not having it. That is not a coincidence, and it is not an accident of arithmetic. The surcharge was set at that level deliberately, so that for anyone above the threshold, the private option becomes the rational one. It is a tax designed to be avoided, and avoiding it is the entire point. Level 4. You earn $260,000. Your name is David. 52. A specialist consultant in Perth. And this year he crossed a line that almost nobody sitting below it has ever heard of, because it is never mentioned in any conversation about tax brackets. It is called Division 293. Above $250,000, the tax on your concessional super contributions doubles. Instead of 15%, they are taxed at 30%. And unlike almost every other threshold in the system, this one is not indexed. It has sat at exactly $250,000 since the day it was introduced, which means that every year, quietly, more people fall into it without their real income having changed at all. On the surface, that reads as a penalty on high earners. It gets reported that way every single year, usually with the word crackdown somewhere in the headline. But run the actual arithmetic on it, and something quite uncomfortable falls out the other end. David's marginal rate is 45% plus 2% Medicare, so 47 cents in every extra dollar. When he puts a dollar into super, instead of taking it as salary, that dollar is taxed at 30% because of Division 293, rather than at his 47. He saves 17 cents on the dollar. Now go back to Tara. Her marginal rate is 15% plus 2% Medicare, so 17 cents. When she puts a dollar into super instead of taking it as wages, that dollar is taxed at 15. She saves 2 cents on the dollar, and she has to lock the money away until she is 60 to get them. 17 cents against 2 cents. 17 cents against 2. The person the system is supposedly penalizing still gets more than 8 times the benefit from performing exactly the same action. The penalty tier is the better deal, and it stays the better deal even after the penalty. That is the pattern underneath the whole structure. Progressive tax rates make the headline look one way, and the concessions built on top of them quietly run in the opposite direction, because a concession is always worth more to the person with the higher marginal rate. That is not a loophole, and nobody is cheating. It is simply what happens when you build a flat rate discount on top of a progressive scale. And the concessional cap went up to $32,500 this year. David can use all of it. Marcus can use perhaps a third of it before it starts hurting his mortgage payments. Tara could not get anywhere near it and would gain almost nothing if she somehow did. The cap is the same number for all three of them, and it is worth a completely different amount to each. So those are the 4 levels. At 1, the office is invisible. At 2, it starts asking for receipts. At 3, it starts charging you for choices you made outside the tax system entirely. At 4, it charges you more and hands you a better deal at the same time, and reports the first half of that sentence without the second. The thing worth knowing is your marginal rate, not your average one, because every decision you make about salary, sacrifice, overtime, or a deduction is priced at the margin. And if you are anywhere near a bracket edge, that number is the only one that matters. Everything else is background noise. Tell me in the comments which of the 4 levels you are sitting on this year.